Hello, my name is David Boris, and for the past 30 years or so, I've been a New York City-based investment banker. As the former head of investment banking at Ladenburg Thalmann and Company and president of Ladenburg Thalmann Group, and as a co-founder of Morgan, Joseph and Company, or as a senior banker at the other firms I've worked at, I've had the opportunity to help many companies, like the ones you represent here today, to raise capital or execute an important merger or acquisition. While I openly admit that I'm a deal junkie, one of the best parts of my job is the opportunity to meet and to work with some truly extraordinary people, like your next speaker, Mark Biersmith. Mark is a special man, not because of the over 70 deals he has closed, not because of the billions of dollars he's raised in the public and private markets, and not for all of the amazing firms and people he has worked with, including my former colleague Fred Joseph, Goldman Sachs, KKR, and Jack Kent Cooke, just to name a few. No, Mark is special, at least to me, because he is one of the most honest, hardworking, and ethical people I have ever come across. And Mark is not satisfied to just be like this, he wants to make us all better people. If you don't believe me, watch a YouTube video of a college lecture that Mark recorded on business ethics. We can all learn something from it, and it's a video that every young person starting out in business would be well served to watch. In any case, we don't have to settle for a video of Mark because he's here as your next speaker. So it's my honor and privilege to introduce to you Mark Biersmith.
Thank you, David. For those who were present at the governor's talk this morning, the governor mentioned a phrase, barbarians at the gate. And some of those who have gray hair remember that whole story. David was one of them. David is probably the most prolific investment bankers in New York to this day. He was the one who defended Fred Joseph. Fred Joseph is the former chairman of Drexel Burnham Lambert. It no longer exists. There's a reason for that, because he had an employee, and that employee's name was Mike Milliken. Remember that? And Mike got ratted on by another guy who was the king of greed. Remember Michael Douglas in the movie Wall Street? That's Ivan Boesky. He gave a lecture at the University of California at Berkeley and mentioned that greed is wonderful. Well, we all know what happened to Ivan. Fred was admonished at the SEC for not supervising well enough. He was not sent to jail or anything like that. But it all teaches us as CPAs the value of supervision. Let me introduce myself. Well, I've done 73 transactions, but I'm a great student. I had the opportunity in my career to learn from some of the best in the world, subsequently to advise some of them. You heard David mention some of them. Others would be the Hearst family, Wasserstein and Pirelli. I don't know if you guys remember them. So I've had great teachers. And of course, Jack Kent Cooke, who, in my opinion, is the greatest takeover artist who has ever lived. And what else have I done? I've raised $1.3 billion in the public and the private markets. I've been in 3 articles, been introduced at the NYSE, spoken at the Harvard Club in New York. I was brought to New York to meet the 58 dignitaries from China. They were all CEOs coming to the United States to make investment in M&A. The lead Chinese person got up and said, you know, there's one thing about American economics that I do not understand, and that is, how can you print money without collateral? And the professor from Harvard said, because you buy it. So that was a great lesson in junk bonds too, right? Somebody bought that stuff. What kind of deals are there? Well, there's stock deals, which are kind of gone away a little bit. There used to be a good reason to do that before the 1986 General Utilities Doctrine, but now you don't see that as much. Asset deals are more prominent and ones that you should execute, because that means you don't assume liabilities, right? Then there's a 338H10 election type of transaction, which says, look, I can't agree with you on whether I buy your stock and your liabilities, but look, let's do an asset deal that looks like a stock deal and we'll work it out. What I want to introduce to you, and the reason why I had David be so kind to give me my introduction, is I want to emphasize the importance of experience on M&A transactions. It's just not the time to have inexperience on a transaction. What is my presentation goal? My presentation goal from the bottom of my heart is to make sure that when you walk out those doors this afternoon, 2 things have happened. The money that you spent to come here has an extremely high rate of return. The other thing is, when you walk out of here, you're not the same person than when you walked in, that you're far more valuable to your employers. We are not talking about tens of thousands of dollars. We are not talking about hundreds, thousands of dollars. We are talking about 7 digits or more. When you walk out of here, you are worth that. And I will prove that to you. What am I not going to talk about? Well, I'm not going to talk about US GAAP. I'm not going to talk about IFRS. I'm not going to talk about the differences thereof. I'm sure we could find somebody in the room who would know all that. But since you are CPAs, I'm going to default. What is inside the scope of this transaction is how to execute. We're going to learn how to execute an M&A transaction so that you have learned the lessons that I have learned from the best transactors in the world. Number 1 rule, the only rule. This is the only thing you really need to leave with this afternoon. So I tried to make it very simple. You know the old rule, make it simple, stupid? Here we go. Buy right, run right, and sell right. Now, some of those you don't have any control of given the nature of your business. There's one that I am very prejudicial to, and that's where we're going to spend our time. Why am I prejudicial to buy right? Because it is at this point, number 1, that you have control. There is one person involved, hopefully, who's running the show. Remember statistics? Yes, no. Either I did my job or I didn't. There's a 50% probability in theory that you're going to do right. When you get the run right, you know how many people are involved? Put that yes-no decision to all those people. What is the probability, statisticians, that that's going to go well? Well, what I'm going to teach you is to buy some insurance because I trust you. I like the yes-no on you. You've worked hard all your life to be in this room. So I can trust you. So I'm going to train you how to make the run right less risky. What is the mortal sin of buying? The mortal sin of buying is paying too much. Mr. Neil Amato, by the way, who's in the room, asked me the question yesterday. He goes, what's the appetite for M&A? I love that word, appetite. Because you know, when you go to the grocery store and you're hungry, is that the time to buy groceries? No, you go when you got a full stomach, when you don't need to do the deal. That's the time to buy. We call that the point of indifference. It is the Goldman Sachs #1 rule in M&A. You buy at the point of indifference. The holy water. Okay, I'm exposing myself again. I apologize. You buy right by creating positive arbitrage on the day you close. What does that mean? That means that you paid $100 and the next day it's worth $120. You got $20 to run right with. If we were taking our production classes, which all of you did, we would call that slack. You built slack for all those decision nodes in the run right. Good example of buying wrong. Do you remember the Merv Griffin show? He went out and bought some casinos in Atlantic City, and unfortunately for him, he got in a fight, a bidding war. Unfortunately, he went up against one of the biggest egoistic persons we all know, Mr. Donald Trump. Boy, was that a war. Who do you think is going to win that one? After Merv won the bid, they interviewed Donald. Donald said, we'll see who wins. We'll see who won today and who lost. Because what he knew is that Merv overpaid. Once you overpay in a transaction, you're done. It is very difficult to recover. So if you think you're overbuying, you walk away. It's not easy to do. When Mike Milliken got arrested down in Los Angeles, I don't know if you guys remember where you were. I sure remember where I was. We were in private equity firm sitting in our office, and we had a junk bond deal going. Mike got arrested. Guess what happened to the junk bond? By the way, we don't use that term anymore because of the event. So we had $1 million worth of bond issuance costs that had to get written off because the market collapsed. And so did that term, by the way. We now call that junior subordinated debt. Another example of overbuying. Did a lot of work with in the newspaper business, but the multiples in the newspaper business back in the 90s, unbelievable numbers. Why? Because they bought it because of ego. The one thing they forgot to look at, though, was the product life cycles, right? We talked about the point of indifference. What does the point of indifference by definition mean? What it means is that emotion is absent from the decision making. Now, you know, there are 4 areas of business. We spend a lot of time in 3 of them. But when you're good at it in the field of M&A, you realize the 4th one is important, right? There's finance, marketing, operations, and organizational behavior. Lay people would call it psychology. A lot's happening in your decision making when psychology and emotion enters into the play, and we'll talk about some of that. Characteristic of an optimal buy. It's ripe for the consolidation. Is the industry consolidating? Why? Because they're trying to get discounts. They can raise rates. All those things the federal government doesn't like to hear, right? Is the foundation for your company strong enough? The way I like to use the analogy here is if you're going to add a floor to your house, what's the most important decision? Is the foundation capable of having that next floor? A company's no different. The one way we try to mitigate our risk here in this is we start small. There's a private equity firm out of San Francisco. They got the opportunity to buy big the first time. Well, it didn't go well. What does that do to the firm? It doesn't help rate of returns, does it? You buy small first. Create your sins, learn your lessons, and then go big. Is the transaction in a sunrise industry, or is it in a sunset industry? A lot of inexperienced M&A people will buy in a sunset industry to consolidate. Not recommended. You're on the right-hand side of the curve. My wife is a math teacher, so I got to be really careful here. But you remember when we used to study slopes? Oh God, I know, you're panicking. But there was this point on the curve where the slope would still be increasing, but decreasing at an increasing. You remember all those terms? Remember that. We're going to need that in a moment. Does target co-transaction contain buyer synergy? That's a fancy word, synergy. What does that mean? That means I can do things better than you. Now, that's not really true. Okay? But if my company can do something better than yours, I'm going to buy you because I've created value the next day. For instance, if I'm a much larger company and I can get purchase discounts and I know you're positive cash flowing, why wouldn't I buy you? That's a great transaction for me to execute. You know, when you go to grad school, you spend your life with these curves. So I try to make it simple. What you learn in grad school or perhaps undergrad is you know that all products and all businesses have life cycles. Traditionally, those life cycles are symbolized by the bell curve. Now we can talk about how high the bell curve is with software, right? It's going to be really high and it's going to drop really quickly. Or perhaps it's a little out a little bit, like transportation until the other night. Okay? But the night is coming. Where on that curve am I to buy? Jack Kinkick taught us the best ever place to buy, and we'll talk about that. By the way, Jack, at the time that he made $250 million in 18 months, made more money than anybody in the history of the United States in a shorter period of time. We'll show you why. The slope is increasing at an increasing rate. Time to buy. You know what Jack did? He never left that point. He would close and put it up for sale. Now, you guys would call that the flip. You wouldn't like working for him. Makes for short careers, but the guy knew how to make money. He did it again when he bought the Redskins. He made a lot of money, upset a lot of people because they knew what he was doing. This. Characteristic of an optimal buy. Keep going. Will the transaction pass antitrust? This is a big deal, right? If you have a high cash flow business, you're buying market share, and there's a Democratic administration in power, you better do the test. It is a mathematical test. It can be done by you. Probably should be done by an expert witness, but it is numerical. You guys are good at numbers, right? Okay, it is a test. You can do this before you go spend a lot of money. And if you got a Democratic administration, you're kind of going up against a big lever if you're taking too much market share. Will the deal size be above break even? This is important, and it's becoming increasingly a problem with the equity raise, right? Which is the reason why the A+ offering came out 2 weeks ago. Not quite mature yet, but you might look it up, you might keep track of it. There's a little bit of problem with it, but right now it's something to think about. But right now the break-even point in New York is probably somewhere around $25 million before an IB person will take it. If it's under $100 million, they're probably going to the personal wealth market. If it's over $100 million, they're going to the institutional investors. It is the institutional investors that you want in your portfolio. Why? Because they're value added. They don't sue very easily. But grandma down in Florida, you lose her money. Whew! Wow, that's not going to be a pleasant experience. Am I a public company? Usually, not always, But usually public companies have higher multiples. Now you got to make the translation, right? Because public companies don't trade on EBITDA. We'll learn that Warren Buffett never trades on EBITDA because he hates it. But a public company can usually, the general rule, buy a private company in the same industry and the next day wake up wealthier, assuming it's material enough to make a difference. That's an optimal buy. See this building down here? That's the Crown Zellerbach building. Georgia Pacific went after them. They made a mistake at Georgia Pacific. You know why? Because they put out a press release before telling the employees. You know what that building looked like that day? Looked like New Year's Eve in New York. The employees opened up the window and out went all the papers. That's not the way to please your employees, right? So if you want to do it right, you want to get in there and find out who's worth saving, and you want to get your equity instruments issued to them. Make it good for them to stay. Remember, we talked about the transactions have a higher probability of success if we have experience on the team. Those managers leave, so is your ROI. Let's talk about the hunt. Who's the best person to go after a company in which the book value is higher than the fair market value? What does that tell the academians? We know what it tells Carl Icahn. He loves these deals. He spends his life reading the morning paper for these deals. What it means is that I can liquidate the company, have cash left over, and I'm good to go. Well, I do those deals all day long, which is why he does. You do not want your company in this position. Okay? That's why you look at book value. Study industry demand curves. I know you don't like to do this, but those are the people you want, right? You want the companies that are going up, not the newspaper business, which is going down, right? You want companies that have a future. Moving on to the transactional cycle. The way this talk moves is that we're walking through the life cycle of the transaction, from the point of buying to the point of selling. Next step, the confidentiality agreement. First advice, we're going to talk about buying a company is no different than buying a product. I meet his needs. He doesn't meet mine. He's not going to sell to me because he met my needs. He's going to sell to me because I met his. This is the gimme. They get all riled up about the confidentiality agreement. I have never, in the course of my career, ever found that this document was very important. Give it to them. If they want to draft it, let them draft it. There's two things in there, though, that you want. You want the no shop, if you're the seller. If you're the buyer, you want it absent, because you're going after those employees if you walk away from the transaction. So if he's the highest producer in the manufacturing plant, by the time I get done with my due diligence, he's going with me, whether or not I buy the company. Value of information, due diligence. I like to drive home the importance of due diligence. My audience here today is really good with due diligence. They like numbers, they know how to do it, they can be there all day long and be really happy. But let's stress the importance of it, because you got to sell it to your boss. It's expensive to be on site. So the examples I like to use to help you sell it to your boss are these three examples. Napoleon, do we respect him? He knows how to win wars. When asked why did he win so many wars, his first response was, because I had information. World War I, the classic line is, loose lips sink ships. When I was in my firm, one of my partners made a slip of tongue to the market. Unfortunately, it was to Fortune magazine. And the next day, we got an email from the managing partner. It says, loose lips sink ships, and this one sunk. So we lost the deal because we ended up advertising. World War II. Alan Turing, everybody see the movie? That was all about information, wasn't it? Once he cracked the code, he won the war, because he had the information. The person with the most information is the person most likely to win. That's who you want to be. How does the buyer gain ground? Well, you're going to love this one. Warren Buffett, everybody likes him, right? We respect him, so we're going to listen to him. If they asked him what is the one thing he would do over in his career, you know what he said? He would have done what you did. He would have learned the language of accounting, because it is the language of business. The reason why you put initials behind your name is so you're better than your competitor. So you're good at this. You're in the right place. Due diligence represents operational. That's not you, right? So you got to bring your colleagues along. There's a management concept that called participation breeds acceptance. You don't have the expertise to tell me if a cellular tower is working right or it's the most efficient way to do it, but your colleague knows. So you got to develop a team. The team includes not only you, but the operational people. Now, I'm sorry, but I have to tell you the bad side of life too. Is that okay? Because this world is ugly in M&A, as you know. 50% of all M&A transactions end up in litigation because people get hurt. Why are people hurt? Organizational behavior tells us people get hurt because they have a sense of injustice. Well, here's one of those deals. I walked into the business. I had no intent of buying that business. All I wanted to do was learn about the competitor. Signed up a CA, walked in, learned everything, walked out. Never had any intention to buy this company. But boy, I know how to compete better. Did I drive my value in my company when I walked home? You betcha. So this is something you don't want to happen to you. So what do? You lock them in. Okay, that's what letters of intent are for. Proper role of professionals. Boy, what a waste of money. I walked into a deal, and there's a very famous case that happened in the United States, and it had to do with a discrimination case. The lawyer won a landmark decision, and frankly, our country is better off for his victory. However, his next client was a company, was involved in an M&A transaction. Unfortunately, he walked in when we were doing business with KKR. Poor guy never knew what hit him. Didn't even know how to draft a purchase agreement. So we drafted it. One thing we learned about purchase agreements, the person who does the drafting is a person who usually wins. Now, why do they want you to do that? You say, it's because lawyers are expensive. They got to draft the document. It's about this thick. Put the schedules in, it could be this thick. It's expensive. But it's far more expensive if you lose control of the document. So if offered, say, sure, I'll do that for you. Whatever I can do for you. Right? It's relationship selling. M&A work is a regulated business, just like auditing is. If you do third-party M&A work, let me advise you, you have to follow the rules of your state Board of Accountancy, just FYI. I'm going to talk about banks for a moment. When you walk in with an LOI, if you really want this company, the way you walk in is you walk in with a bank commitment letter and an equity commitment letter. Why? There is this famous dinner. Whether you believe it or not, it makes a point. This dinner happened about 2015 years ago, and there were 12 men at a table. We can argue about whether the woman was there or not. And the way I always like to teach people to sell equities is to remember this. 11 of those people sitting at that table took things on faith. They were easy sells. One of those guys had to touch and feel. Okay? He had to feel this chair to know it's here. That's the way you sell equities. If you sell to that non-believer and you get him with tangible evidence, which is the way you sell him, then you got the deal. Okay? That's why you show up with the equity letter. That's why you show up with the debt letter, because you're not fooling anybody. Relationship selling is about trust. There's nothing to dispute here. Here's David. We talked about him. The reason I'm going to go through these next 3 slides is to show you what experience is defined as. It's not calling your regular lawyer or your regular CPA firm and say, hey, go do the due diligence. You want people who are very experienced, people who know where the cheats are. Okay? You know David. This gentleman here, Paul Howe, wrote the rules on tax. You know the deferred tax rules? Now they renamed it AS something. Okay? There he is. That guy knows what he's doing when you walk into his office and he's looking at transactions. By the way, all transactions are tax-based, not GAAP-based. A lot of people go in and look at a transaction and the only thing they're concerned about is US GAAP. Wrong. Why? Because NPV, IRR, is impacted by what item on the balance sheet? Cash, right? So you want to go see tax people. This gentleman here, just to give you a flavor of the experience level, graduated #1 in his class in Notre Dame. Went on to graduate at the University of Texas, at the top of his class. He's done many deals. That's the type of experience on the law side. He likes to yell at me a lot. That's okay, as long as I'm listening. All 3 of those people watch their tone when they're dealing. All 3 of those people don't touch my deal when I'm negotiating, okay, because you only want one negotiator in an M&A deal. Classic example. We walked into a major corporation in the United States. The conference room was beautiful. I did have slacks on. There were a lot of suits, ties. These people were from every field you can imagine for this M&A transaction. What they didn't know is my consortium partner and I had called all the bidders together, divided up the market, and went in to make a bid. We call that consortium bidding. That bid was $600 million less than they were expecting. That's a lot of money. You guys might even get a bonus if that happens to you. That's real stuff, real money. That deal did go down. Went down with a public offering for obvious reasons. Did we make money the next day? You betcha. Projections, this is what you're really good at it, but this is also how you end up getting out of your license, right? The general rule of thumb of projections, the AICPA, they're going to love this, is they actually have a rule book on projections. It's called the Guide to Prospective Financial Statements. It does exist. You need to follow it, because what happens is when, not if, you end up in the courtroom, you can say, hey, all I did is follow the guide. What does it say? Number one, you have disclaimers everywhere. Number two, at the top of the page, it says, be sure to look at the disclosures in the back, which gives you all the assumptions. If you don't like the assumptions, make your own. Don't blame me. It's hard to get in trouble when you follow that guide. I highly recommend it. The other thing I like to point out is that the buyer does not pay the same price as the seller. It's not like you go into the grocery store and the guy rings up 5 cents for the bubble gum and you give him a nickel. M&A doesn't work that way. What you sell to me is not what I'm buying. If that's the case, I'm not interested. There's no arbitrage there. I'm always buying cheaper than you're selling. So when you go do your allocation of assets, you have to remember that. Let me just mention one thing the CEOs love to do, which you need to fight back on. Number one, they like to push the numbers, right? Because they're trying to get a deal done. And guess who in this room is going to get in trouble when you don't meet the projections? We all been there, haven't we? CEO pushing, that only leads to trouble. One area in which they push is administrative synergies. Crown-Zellerbach, good example. People love to wipe out accounting departments. No offense. But it doesn't work, does it? You know, if you're processing $25 billion worth of transactions and it's going to $100 billion and you think you don't need additional people in the accounting department like the CEO thinks, is that going to work? The way I like to advise people is don't wipe the administrative cost out. If that's what you're doing to make the transaction work, walk away. The transaction needs to find its arbitrage in operations. What really drives multiples? All right, so let's learn a little bit about multiples. OCF, right, times market multiple equals enterprise value. EBITDA times market multiple equals enterprise value. Is that equity value? No, you have to subtract secured debt to do that. Those are your formulas. You live by those if you're in the M&A world. You can add value to a transaction by affecting either one of those numbers, either the OCF, operating cash flow, EBITDA, or the multiple. What you really want to do is do what? Not put an or in there, you want to put an and. So if I can add purchase discounts and I'm a public company and I'm buying a private company, boom, you've hit gold. This drives people crazy, but I think we all know this is true. There are two sets of books, Al Capone. You weren't wrong. There's the books, US GAAP, and there's a tax. The one that means the most when you're looking at NPV is the tax. So when I do projections, I want to see a couple of things. I want to see the tax impact and the book impact, and more importantly, I want to see the statement of cash flows. I had a colleague, it was 3 o'clock in the morning, and guess what they didn't do? And we had a bid due at 8. They forgot to hit the save button. Whew! You know, you only do that once in your career because you are going to pay the price. We'll see you at 8. You see the 5-year one there in the middle? This is another great opportunity, and we talked about this the other night at the panel. In cyclical companies, you always want 5 years. With cash flow companies, you only want 3. Why? Because as a buyer, what you're trying to do is capture the recession, right? Lowers the price. Buy on a 5-year average. Multiply it by the market multiple, You're done. There's your purchase price. But we have a great opportunity, which is the reason why the M&A market's going crazy. Because I'm going to walk into your office, I'm going to have the 5-year numbers, and guess what's in 2010? The Great Recession. That dip is something we hope we don't see again, but it's a low number. It creates a very low purchase price, and guess what I just made? If somebody says yes to that deal right now, it's a go. Now, cash flow businesses, that wouldn't be true. We finance those differently. Valuations, a lot of mistakes here. I remember a private equity firm who was trying to buy our company, did buy our company. We sold it at double the market value. All the other bids were half of what this firm's were. Why? Because they didn't understand this concept. This is a great example of how we can stay out of trouble. First of all, not every industry is valued the same. The reality is the academic principle behind valuations is financing. The value can only rise to the point in which the value can be supported. Otherwise, you can't get it financed. Everybody's wasting time. So at the end of the day, everything's about cash. Well, everybody here thinks EBITDA times multiple gives me my enterprise off and running. Well, a couple things about that. First of all, if you're educated, which all of you are, we know there's something to EBITDA that we have to do first. That's called adjusted EBITDA, right? Now, if I'm the buyer, am I going to adjust OCF for non-recurring, definition of adjusted EBITDA, non-recurring expenses? Am I going to bring that up? No, I'm not going to bring it up. And the guy next to me who does, boom. Right? Because it's not only the adjustments now that are going to cost me, it's the adjustments times the multiple. We just lost 7 digits. Now, if I'm the seller, am I going to bring up adjusted EBITDA? Oh boy, you ought to see my sheet. It's a mile long. Now, there's some ethics involved. I know, we'll talk about that. But you cannot imagine what my adjusted EBITDA sheets look like. Somewhat similar to the income statement. One other thing I want to talk about, the number of reviews you have is directly proportional to the quality of your projections. If somebody wants to take a look at my projections, here, please do. Make fun of me, okay? I was never the prettiest guy in class anyway. Go for it. You want people to look at your transactions. Here's why. I was in private equity. Had a gentleman from a very renowned school, graduated from finance, and he did an Excel spreadsheet. Very talented young man. He's in Forbes magazine. Everybody trusted his work. Bought the deal, signed the papers. Off we went down first day. We looked at the projections, looked at the financial statements. Whoa, these are off. We went back to the model. Remember these things called check digits? Hash totals? That professor auditor taught us to make sure you put in your spreadsheets? Wasn't there. EBITDA had been entirely overstated. We had to lay off 350 people. So you owe it to society and to people to have high quality work product in your projections. And remember to protect yourself. Negotiating technique, the tired seller. There is a point, a famous coach once said, when you've decided to retire, when you're thinking about it, you already have. That's true of M&A too. That person is thinking about the beach, is thinking about, you know, I've worked hard all my life, I'm actually going to go home and see my wife and children, hope they know who I am. That's kind of hard psychology to pull back on, right? It's your job to get that person there. The way you do it is relationship selling. The desperate buyer. Private equity firms, how do they make their money? They make their money by managing money. And how do they get earnings off of that money? They manage fees. Well, what happens if the private equity firm doesn't have any money to manage? You think they're desperate buyers? Are they emotional buyers? When they got a payroll to pay? I've seen it happen. By the way, usually underlying, only 2 out of every 10 deals in PE work. They know that. So that's why the cost of capital from a PE firm is so expensive, because they include those which are going to go under. Trust. Not sure where to go with this one. I'll just tell you the story and I'll move on. For those who have been hurt in life, especially in business, I asked this one CEO, I said, you know, who do you trust in business? And we were driving to Austin, Texas. He was behind the wheel, and I was in the passenger seat, and he went over to the visor and he flipped it down, and guess what was on the other side of the visor? Okay. Pratt's Stats. Recently did a transaction where the broker came in and put a valuation, to a company? Well, what I did is called up Pratt Stats. Pratt Stats tells you what the industry multiple is. Most people think it's made up. Okay, no. What it is, it's a series of transactions that have occurred in a like market. You take the average, and there it is. You know what this guy did? He used Pratt Stats, but he took out all the things that didn't look good. The valuation, I knew what he did. I went to Pratt Stats and did the same thing. I knew exactly when I went into the negotiating table what he did. The valuation he put on the company was literally double what was truly worth. Fortunately, I was representing the investors, the new investors, and we were able to pull out before they signed the papers. Pratt Stats, great database. The purpose of it is to get the market valuation. It is a tangible number. It can be sold to St. Thomas. He'll believe it. Tell you a great story. We were buying companies in Los Angeles. It was Christmas Eve. We'd already been down there 3 or 4 times. Calls us down there New Year's Eve. Mama's upset. She's ready to open up presents. We get down there. He says, "What are you doing here?" "I've changed my mind." Get back on the airplane. We go home. We land. Back then they had these things called car phones. Car phone's ringing. He goes, "Come on back. Let's do the deal." By this time it's 7 o'clock at night on New Year's Eve. You imagine how upset Mama is at this point. It wasn't mine. It was the managing partner. So he said, "Look, I want to close this deal. I'm going to go down there. I'm going to pay him what he wants. I'm coming home." He did that. Did he overpay? Yeah, he did. He was emotional, wasn't he? He should have let it go. Relationship selling, consortium bids. The biggest thing in American business right now that a lot of you are playing in your companies is personality testing. Personality testing is subject to due diligence. So when you go in to try to figure out how to sell this person, where's the first place to go? You want to know who you're up against. You go to the personality test. Is this person detail-orientated? Does he have ADHD? What's the deal? It tells you how to sell to this person. Use those. Knowledge, preparedness, don't waste time on impractical CEOs. There are a lot of those. They are people defined as people who don't leave money on the table. Every experienced M&A person knows that you should leave money on the table to optimize the deal. What does that mean? Remember the curve? That means you're on this side. There's still a little bit of money to be made. You're not over the top where money starts going down. A CEO who has put their life in that business is emotional. They think it's worth a lot more than Pratt Stats does. If that's a situation, you need to walk. That person will never sell, at least not in a practical way. Donald Trump, a man who I deeply respect, by the way, he taught us all to negotiate from a position of strength. You know, when I asked my wife to marry me, did I take her out to dinner first? Absolutely. Part of the deal, right? Mm-hmm. Relationship selling. Everybody knows what a sales cycle is, right? It looks like a funnel. Remember the old oil funnels we used to put in the car? Then we pour it in. Well, that's what a sales funnel looks like. So you fill it up with deals, pops them, knowing that only a few are going to come out. The further down you get that person into that oil funnel, the more likely they're not going to turn around. They're at the beach. What does that mean? Well, when you go back for dessert and you've called them, okay, in Carmel, because they've already bought their new house, and say, "Oh, by the way, sorry to tell you this, but we found something in due diligence and we're going to have to ask for a price reduction." First thing the guy's going to do is blow up. So you call him back when he's calmed down and say, "Sorry, this is the way it is." Is he going to still sell to you? Yeah, he is. He's already left the company. He's not going back. That's called going back for dessert. Okay? Jack Kent Cooke was the best at it. Deal structure. Why do you transact? You transact because of synergy, market protection, or market share growth. Market share growth for purchase discounts, increase revenue. How do you spot liars? Well, you guys know something that nobody else does. Anytime I get a set of financial statements, which we do all the time, that doesn't include the statement of cash flows, there's one thing I know: the statements are wrong. They're always wrong, right? As soon as you ask for one, they'll come back and say, "Oh, we had some adjustments." So the one thing you guys know that nobody else in the world knows is that when you go to the statement of cash flows, you know where the real EBITDA number is. So whatever they've done, this is the real number, right? Continuing operations. So anytime you get an EBITDA number in a proposal of sale, go right there and find it. Purchase agreement, who's controlling the draft? You are. Another thing in the draft is that if you're selling the company, don't include a PPA. If you're buying the company, you include a PPA. What is a PPA? We'll talk about it in a moment. The LOI. What does it mean? Not a lot. If you're buying a company, it is contingent upon the world. But if you're inviting people into your company, you're going to tighten this up. Because they're going to steal your employees, they're going to take evidence, they're going to take intellectual property, they're going to take all kinds of things. So most of the time, it's unenforceable. But if you're the seller, you're going to tighten it up, and you're going to demand a contingency equity letter and a contingent senior debt letter. So that if they find what they find, they got to close. PPA nightmare. What is a PPA? You guys would think of it, based on your training, as working capital. What the real number is here, remember our enterprise is equal to operating cash flow times market multiple? Well, there's a difference when you talk about enterprise value and a difference between proceeds. This is where a lot of money is made. I walked into a transaction one time and came with my PPA worksheet. We'll talk about what that is in a minute. It was in the purchase agreement. If you're an inexperienced M&A person, it will not be. There'll be a run on your working capital assets. They'll be gone by the time you get there because you didn't put a PPA in your working agreement, in your purchase agreement. PPA is really designed to set the working capital ratio, which is in Pratt stats, to the industry norm. It's designed to go over the argument where the seller says, the cash that I earned that's in the bank account is mine. What do you mean it's not? I earned it. Well, your argument is the company has to have a working capital, and then we get into the argument about what that number is. Well, every industry has a working capital normalcy. It's in Pratt stats. That's what the PPA does. My transactions have been as high as $10.2 million on the PPA. Now, what happened to this seller? I walk in with a $10.2 million PPA. He's already cashed the money. He's already done things with the money. And you said, that's right, you adjust the price. Financing deals. Well, there's the bond market. Purpose of bonds is to finance companies that are good with reliable cash flow that pays the bond, the premium and the discount, and the interest. There's another purpose for bonds, though. The other purpose is that it's a very inexpensive advertising. Before you go public with the equity, you get exposure with your public bonds. So if you can do bonds, remember it's deductible for tax purposes. If you run out of senior debt and you add on subordinated debt to your transaction, your cost of capital has gone way down, right? But only do that if you're in an industry in which the cash flow is reliable. If you're in a cyclical industry, you would not get bonds, in my opinion. A-plus financing, real quick on that. It's a new one. I talked a little bit about it. You have exempt registrations. Okay? A-plus offerings are designed to get you out of the institutional market, start taking advantage of some technologies like crowdfunding. There's new rules out there. Read it. They'll be in place probably within 60 days. The disadvantage, once again, is grandma in Florida versus a New York institutional fund like MassMutual. Investor presentation roadshow. How long is it? 30 minutes. It's not an hour. It's not 2 hours. It's 30 minutes. And by the way, don't serve eggs. Nobody eats them. Serve healthy meals. And then you use it as a sign of your healthy company. But roadshow presentations are 15 minutes with 15 minutes of Q&A. What's in there? There it is. The industry, the management team, the company, and the projections, which you now know how to do. When you do the roadshow, especially in New York, they can be tough. When you're in that conference room, they are not afraid to tell you the way it is. It's kind of like that show. What's the name of that show? Shark Tank. That's real stuff. That's exactly the way it is. And when you face that tough question, like you've wasted my time, this is junk, blah, 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 you just say, look, I didn't come here to ask you or make you invest in this company. I'm giving you the opportunity. You don't choose it, that's fine. There's other people who are willing to go. I have never made that statement and not closed a deal with that company. Then the next question is, do you want them in your deal? That's a different issue. Run right. This isn't you guys, for the most part. But if it is you, what are you trying to do? Well, in your mind, when you walk out that door today, you will remember enterprise value, OCF times market multiple. We're off the multiple. We're now on to OCF. So your job is to make sure that OCF goes north, not south, Because if it goes south, so is the company in the deal. And oh, by the way, remember the projections? Who are they coming to? So basically in the run right, it's your job to have built slack when you get to this phase, because you know your team has a learning curve, and your goal is to drive OCF. Best practices, you hear that all the time. Is it real? I don't know. It's tough, isn't it? You know, they did a study in Forbes magazine. Excuse me, men, I'm going to make fun of you for a minute. Girls are going to love it. They did a study of CEOs, all male. They found that 90% of male CEOs, when faced with change or death, passively or actively, chose death. So how do you think best practices works? You want to have your ears open? Let me give you an example. We had a company. It sold musical instruments. And a due diligence exercise walks into the shop, goes to the warehouse, and looks in there and says, boy, you have a lot of beautiful instruments. Guess what month it was? October. School's already started. Not good. Building OCF. I just went through this exercise at Ariel Investments. Very talented young person walks into my office and says, I need a 10 grand raise. I said, well, I'll tell you what, I'm willing to give you a 10 grand raise, but it's not coming the way you think it is. Why is that? Because that 10 grand raise in the world that I deal with has a multiplier. Remember, OCF times enterprise multiple gives you your enterprise value. That 10 grand raise is really 150,000. So if you really want 10,000, then I need to take your $10,000 and divide it by 15, and yes, I'll give it to you. This is a great argument for your staff when they come in to increase awareness of really what a dollar is. Run right. You know, there's an old saying in American business that a dollar worth of revenue sales, let me show my prejudice, cures a lot of sins. It's true. You as a CFO has the option to fix costs once when you're doing a recovery, but you've got to have that dollar worth of revenue to make it grow. So you want to make sure you have a growth market, right? So you can build markets. Sell right. We got to remember when we sell right what the 5 phases of psychology are. Denial, anger, bargaining to regain control. Is that the time to be in negotiations? You're going to lose there, right? Nothing's going to be gained. Sadness. His company is leaving, her company is leaving, that she spent a lifetime building. Or acceptance. Where in that field of thinking are you most likely to get a deal done? Acceptance. So when you're in to do your due diligence, you want to make sure the company you're looking at is truly willing to let go. When is the time to buy? We got our slopes back. The slope has started to decrease, but it's increasing at a decreasing rate. Whoop! Time to sell. You get on the other side of that curve, you're in big trouble. Now remember, when you do your projections, when you do your NPV calculations, you make sure that you put your exit price in. OCF at the time in year 5 times the multiple gives you your buyout price, less your PPF or PPA. That goes in your projections, right, to determine your ROI. Most projections that come across my table forget to put the exit price in. I'm associated with the International CEO Club in New York. And it's amazing to me when I go from meeting to meeting how many CEOs are not left. And the one mistake that I've gained from that experience is that they don't sell. They don't sell at the right time. Why? They're emotionally wrapped. They put their heart and soul into this company. And it's hard to let go. I advised a colleague who's actually in the club. He had one company that was going south and another company that was very solid. All he had to do is let the south company go, cash out of the solid company, go home and enjoy life. He couldn't do it. He couldn't do it. He went under. We're accountants, we know this, but I just want to mention it. When you walk in and you look at a financial statement, the one thing you don't want to do if you're selling is have land and building on there. You want to put that out of the projections. There is no value in the OCF. You have a little add back for the rent, but get rid of the real estate. Should you keep it? No. Should you dispose of the property and not let the new people be landlords? In my opinion, yes. Why? Well, academically, remember the curve? Which way is this company going? It's not too far from the top, and it's going to go south from there. Is that the type of renter you want? Sell it all. It doesn't have to be to the same person, but you should dump. You know, Goldman Sachs has a great rule of investing. You take out when you can that which you invested and risk the rest. If you're selling, the one thing you want in your letter of intent, this just happened in the United States, is the breakup fee. You put a lot of money into this deal. You actually wrote the PPA, right? We learned that today. That costs money. Now somebody just went south on you. That's why you put breakup fees in. You leave me, you're reimbursing me. If this letter you delivered that has the equity player on is not real, you're paying me for all my transactional costs. Now, is that good for you? No, it's not good for you because the employees are already down on morale, right? Final comments. In the M&A world, there's a lot of people who ended up in orange suits. You've heard some of the names today. I cannot tell you the number of people that I have worked with who are in orange suits. I have been in the office when they've come in with the handcuffs and pulled partners away. I have found that the one characteristic that they all had is they all felt they were smarter than everybody else. Don't be that person if you're going to play in this world. Stay ethical in life. My niece's graduation, I was at, and Justice Stith had a great line, which I wish to share with you as you walk out the door today. It takes a lifetime to build a reputation. It takes only a minute to destroy it. In the M&A world, that can happen quickly. Do not let it be you. Do your projections quickly. Make sure you have your disclaimers and your footnotes disclosures, and make sure you're talented in what you're doing. Do I have to mention it to the other side of the table that they made a mistake? Ooh, that's an ethical question. Now we got a problem. We represent a party who's going to benefit from this mistake, right? And by the way, there's some rules that we have to follow that say we got to protect our client. So do we speak up? I think that the answer to that, if you have 3 letters behind your name, the answer is you have to do something. Now, if your colleagues are in control of the negotiations, that's another issue. It's not your problem. But the way you eliminate your ethical responsibility there is through disclosures. I'll end with this. That which we started with, hopefully, that which you'll leave the room with, having created value for yourself. You optimize an M&A transaction by buying right, running right, and selling right. I thank you all.